Good morning and welcome to the Bowmans Budget 2025 webinar. I'm Mike Benetello, an executive in tax at Bowmans, and I'm joined by a panel of specialists that are going to help unpack the 2025 budget. By way of introduction, starting with our economist, Francois Fouche, from the Gordon Institute of Business Science. Francois is the co-founder and director of Boundless World, a research fellow at GIBS, and hails from the earlier Wharton Econometric Forecasting Association, which is a USA-based commercial think tank founded by Nobel Prize winner Dr. Lawrence Klein. Today, Francois advises central banks, governments, and industries on all matters related to trade and investment. He also teaches global trade and economics at GIBS and the Northwest University Business School. Welcome, Francois. Also, welcome to my colleagues Robyn Berger, Roné and Yasmeen, Suliman, all partners in the tax practice of Bowmans. So starting off, and I think you all know this and we all understand, the budget is not only just about tax and tax proposals, but there's a whole lot more that goes on. And in this difficult world and strange world we find ourselves at the moment, and what's gone on in South Africa over the last couple of weeks, given that we finally got a budget yesterday, I'm going to hand over to Francois Fouche to deal with the more important economic aspects of the budget. Thank you, Francois.
I'm going to share my screen here. Let's do this. Hang on a second. You should be able to see my screen now. All right. Thank you, Mike, and a very good morning to everybody. Yesterday's budget was take two. When studying the details of the extensive 270 pages publication, I'm not sure, however, that this iteration can be seen as a so-called improvement. The title of the budget should have been something like Beyond the Budget, Crafting South Africa's Growth Story, a call to action or a roadmap for action, but it was not. The budget is an exercise in planning, which is really necessary in any government in fiscal policy. But we should keep in mind that it is simply a set of promises, some of which seem like, in South Africa's case, plugging holes in a sinking ship, to be honest, since hard decisions were left out yesterday. To restore the trust, we need to talk more about what we have done and not constantly about what we are going to do. Quantitative promises, as we see them being articulated in the budget, are certainly good and necessary for planning, but not necessarily for discipline. And the reason I mention this is because discipline is, in essence, choosing between what you want now versus what you want most. And if we look at the budget, one cannot really evaluate a complex budget with a single good or bad or a score out of 10. The devil really is in the detail. Even though we have limited time this morning, I'm going to highlight a few of those devilish details. If we cast our mind back a month ago, we heard that we have a hole that needs to be filled with a steep VAT increase. However, we need a different approach to set aside the mindset that we need to raise more money from the public and taxpayers. We don't need to do this if it does not grow the economy. In my mind, public expenditure has become wasteful, and while this remains the case, we should rather strive to have less of it, not more. This is simple, but it is hard to achieve. Government are the custodians of the public purse and should therefore act in a responsible way in managing the fiscus. But our government must learn that they need to cut their cloth to suit the way in which the fiscus should be run. Over the last month, the budget has become a surprise. Our aim should, however, be to make the budget more predictable and to make it dull again. Sudden, unexpected spending increases need unexpected tax changes, and that's not good. A day of high drama may have been exciting, politically speaking, but the type of investors we want to attract are the big pension funds that want to park their money in a dull and predictable country with decent growth prospects, and not speculators who buy and sell bonds on cabinet leaks about a budget 24 hours before it is delivered. So a month ago, suddenly everyone had an opinion about the merits of tax increases versus expenditure cuts. More importantly, everybody now understands that a 60 billion rand hole is worth, or what it is worth in real money. It's the equivalent of a 2% VAT increase. But how do we bring back the dull budgets? If we cast our minds back, during the Trevor Manuel days, budgets were predictable and they were boring as well. But in recent years, the budget has become more and more surprising. The problem is that unexpected spending increases need unexpected tax changes, and unexpected spending cuts require badly planned cuts to services. The consequences are distressed taxpayers, more potholes, and hospitals without doctors. But what was perhaps better in Trevor Manuel's days, when the mini budget was the real budget process and not a sideshow? I think 3-year budgeting also allows the finance minister to do things, though they need to be flagged well in advance and phased in. And many of the solutions to South Africa's fiscal hole will require a few years to get through. I think the Treasury has made, or has rather been conducting expenditure reviews and has had excellent ideas on where savings can be achieved in the budget. What hasn't happened is a sober sort of evidence-based discussion on what the country's medium-term expenditure priorities should be and how the cuts can in fact be implemented while protecting frontline services at the same time. I think instead, in recent years, budgeting in SA has been about borrowing more and more to match even higher spending demands, a so-called pay-as-we-go budgeting system almost. In the end, I suspect what has happened here is that Treasury had little option but to turn to the big bazooka of a VAT increase. South Africa's growth, however, in my mind, is too low and spending is too high given the size of our country's tax base. For us to return to long-term fiscal sustainability, spending must be reduced to align with the level of economic activity that we have. If we cannot grow faster, we will have to spend less. And this budget crisis has brought sharply into focus, I think, 5 key points. And the first one is South Africa should return to the discipline of 3-year budgeting. The Government of National Unity must align its policy agenda to the country's limited fiscal resources. The state must review expenditure with a view to closing non-performing programs and entities. Large savings may require dismantling costly bureaucratic architecture. And I do know this will take time, but we need to start now. And then lastly, in all honesty, there's no substitute for economic growth. But this requires far more ambitious and faster structural reforms that are in fact implemented. If we look back at the bungled budget the last month, it has certainly dented our fiscal credibility internationally. But it is also, at the same time, an opportunity for the Government of National Unity to confront the hard policy trade-offs that are required to secure our country's long-term fiscal sustainability. So I would place an emphasis on trying our utmost to bring back dull budgets. Budgets are not supposed to be like the movies. They should be boring. What we are experiencing is administrative bureaucracy in the budget process, but at the same time, we are also seeing democracy at work with the Government of National Unity pushing back on a quick VAT hike that didn't go through 30 days ago. If we look at the long-term real economic trend of South Africa's growth over over more than 50 years or so, we'll find that the trend is clearly not up. Yesterday in the budget, National Treasury shared with us that they've modeled 2 alternative scenarios in terms of the growth forecasts to the baseline forecast in the budget. Scenario A models a very rapid infrastructure investment program, which is supported by successful scale-up of capital spending, mostly by public entities. Investments in this scenario increase energy supply more than the forecast, also in rail and in ports that recover lost ground in transport volumes. And as a result, productive capacity and business and investor confidence pick up, reducing our sovereign risk premium at the same time. In this scenario, inflation declines in the short term, and it sort of settles in the middle of the inflation targeting band. And then the result from that is real GDP growth in excess of 2.5%. The other scenario, scenario B, models a once-off shock of slowing global growth due to increased trade fragmentation and uncertainty. That's mostly the orange hair effect on the global economy. It also contains restrictive trade policies and block divisions that weaken global trade and investment, rising costs, persistent supply constraints, sort of sticky inflations or sticky inflation rather, that are limiting major central banks' ability to cut rates further. In South Africa, in that scenario, there's import inflation, there are lower exports, and there's subdued global demand, all combined with higher interest rates and foreign capital costs that reduces GDP growth to about 1.5% this year. I should mention that National Treasury has always been rather optimistic in their forecasts over the last decade or so. And in my mind, our economic growth will not surprise on the upside if reforms are not forthcoming. And those are the hard things to bring or to actually implement. If we look at the cost of debt and the quantum of debt, yesterday's budget illustrated 4 key fiscal characteristics. The first one is that public debt is anticipated to peak around 76% of GDP. You'll note from the chart on the right-hand side that this is higher than what was anticipated in the mini budget at the end of last year, but also the result of a growing primary budget surplus, meaning revenue exceeds non-interest spending. Thirdly, debt service costs will peak in the current year at about 21% of revenue and is anticipated to decline after that. That's 21%. So that means for every rand that we have to spend or that we can spend, 21 cents are going to service the debt burden. That is insanely high. We were at similar levels a decade or 2.5 decades ago, but we grew out of that one. At the moment, I don't see an environment where we can, where it's going to be likely that we will grow out of that again. And then the last point on this one is that the consolidated budget deficit is expected to narrow from 5% of GDP to about 3.5% of GDP, but it will take us 2 to 3 fiscal years in order to get there. Is our debt service costs high compared to our peers or low? The chart on the left-hand side, the red dotted line, and the red line for that matter, clearly shows that it is high. There's no doubt about that. Just a few words perhaps about the fiscal anchor that was missing in action in yesterday's budget. Unfortunately, nothing new regarding a proper fiscal anchor was mentioned, only that the debt stabilizing main budget primary surplus will serve as the fiscal anchor according to Treasury, and they anticipate larger primary surpluses planned for the remainder of the decade that will reduce the debt burden as a proportion of GDP overall. It's a promise. It hasn't happened as yet, and in the past, they haven't been particularly good on delivering on those promises. So the debt stabilizing primary surplus will probably anchor fiscal policy over the rest of the decade. National Treasury's discussion document about fiscal anchors reviews the global experience with fiscal anchors and assesses how institutions can be reformed to strengthen the sustainability of budget practices. Unfortunately, it focuses on procedural reforms rather than sort of numerical hard limits. And Treasury says that given, well, this is the case because given their positive impact on transparency and accountability. Not so sure about the accountability as I am on the transparency. It's hard to get excited about this since the very great procedures that we have could not prevent us from ending up in this fiscal mess that we currently find ourselves in. So just very briefly, where does the money go? The single largest expenditure item in the budget is in fact interest on our debt burden. We do not have fiscal discipline, or we have not had fiscal discipline over the last 15 years, in fact, since 2009. So we pay the price. We spend more on interest payments than we actually do on basic education. Even though we spend so much on basic education, we have little to show for it in terms of the impact that we create in basic education or just in functional literacy overall in the country. If you were to compare ourselves with some Nordic countries, which spend proportionally similar levels on education, they, however, produce great results. I would argue that we have a spending efficiency problem in South Africa that is just articulated in the budget. We do not have a lack of funds problem when it comes to the budget. It is clearly a spending efficiency problem. A very quick recap, what has happened to debt service costs and education costs over the last decade and a half. From 2010 to the previous fiscal year, you can clearly see from the chart that debt service costs and higher education and training costs in the budget are the two line items that have grown significantly faster than other line items in the budget. What has happened if we look back over the same time period to the growth in government expenditure, in government revenue, and in household transfers, but we do so in real per capita terms, and we normalize it, we'll find that revenue has grown significantly slower compared to expenditure and compared to social benefits provided to households. And as those have diverged, the gap has opened up, and we funded that gap by borrowing money and now paying a large interest bill on the stockpile of debt that we've accumulated because of this. The rising tax burden is certainly clear, and it's real and a present danger in my mind. This is most acute in personal income tax, as you can see from the chart, where the slope of the line is very positive. Value-added tax, however, sort of muddling along. Corporate income tax is slightly in a different direction if we compare it with personal income tax. So the burden of the personal income tax level is certainly going in the wrong direction. South Africa also has the highest tax burden in the main BRICS countries. If we compare ourselves in this chart against Brazil, against China, against India, against Russia, we'll find that we certainly appear to be the outlier. So it's not as our tax burden expressed as a proportion of economic activity, if we measure it by GDP, certainly much higher than the main BRICS group. If we look at the VAT thing that happened yesterday, the VAT question and the US foreign policy question have something in common. They both involve pragmatism. The VAT debate has been fascinating because it is so multifaceted. Several things can be true at once of this debate. It can be true that VAT is the best tax to hike if you have to raise more revenue, but it can also be true that political parties see political advantage in prioritizing different mixes of tax and spending. However, what has got lost in the debate is that a VAT hike is not necessarily progressive. It may be progressive, it may be more progressive than some other options on the revenue front, but hiking VAT and taxing anyone more is not progressive in and of itself. It can be progressive if it is paying for redistribution, but this is also a very complex area in South Africa. The South African tax and benefit system is already one of the most redistributive in the world, so it is highly progressive by nature. It's a political choice, I suspect, whether it should be more progressive than this in future. Political will is certainly required to change the current budgeting process, but it is quite clear that what has happened cannot work again going forward. And in this regard, I think the Government of National Unity could emerge stronger if it gets this right and addresses this. If we look at VAT paid by South African households, just for a little bit of context, VAT is a tax on consumption. A rate increase affects all households through price increases. But most VAT is in fact paid by higher income households which consume more. So over 3/4 of VAT revenue is in fact derived from households in the top 4 expenditure deciles. And these are households that typically spend close to 120,000 Rand or more per year. Now, yesterday, according to National Treasury, increasing taxes on consumption through higher VAT will have the least detrimental effect on economic growth and employment over the medium term, and relative to increases in personal or corporate income tax as an alternative. Also, according to the National Treasury, raising personal income tax rates is likely to be inefficient at this stage, as taxpayers make adjustments to reduce sort of their tax liabilities against that. Higher personal income tax rates may also reduce the incentive to work and save, with potentially a sort of negative effect on the economy. Certainly, I think over the past decade, several measures have been implemented to raise personal income tax. While these have increased the tax burden on individuals, the tax rate increases generated less revenue than originally expected. South Africa's personal income tax collection, measured as a contribution to GDP, and the sort of top rate are far higher than those of most developing countries, in fact. And for these reasons, National Treasury mentioned yesterday, they decided that personal income tax rates should not increase, although additional revenue is generated by not adjusting for fiscal bracket creep. Then just a couple of points on the zero-rated VAT items before I conclude. The VAT system currently zero rates 21 essential food items in an effort to make them more affordable for lower income households. The budget yesterday suggested to extend this list of zero-rated basic foods to mitigate the effect of the VAT increases. And from the 1st of May this year, zero rating will be extended to include a larger basket of food items. The decision considered the risk of tax base erosion and the distributional impact of the items that government identified. However, as you can see from the chart, zero rating is a blunt tool to assist lower income households, because there's no guarantee that it will in fact result in a reduction in prices to the consumer. Zero rating is a not well targeted results in a large portion of the revenue forgone, sort of benefiting higher income households. I do, however, think that the latest income and expenditure survey that National Treasury used for their analysis show that a high consumption of the proposed additional items in the lowest 4 expenditure deciles. So it is estimated that these measures of the additional zero-rated VAT items will cost government about 2 billion rand in foregone revenue. Quickly, just a one stop here at economic multipliers and what was mentioned yesterday. Last year, Treasury mentioned in the budget that the fiscal multiplier was in fact below 1. And let's just quickly look at this, what it means and sort of what the implications are. The whole analysis is based on the multiplier effect. So what is an economic multiplier? What is simply just the ratio measuring the extent to which national income changes in response to changes in government spending. So, for example, a fiscal multiplier of a half, of 0.5, implies that the national income increases by about 50 cents for every 1 rand of additional government spending. So look at the construction sector and what the minister shared with us yesterday. The construction sector is at the center stage of this large-scale investment in infrastructure, growth-based endeavor that Treasury wants to push hard. So and they estimate that for every 1 million rand increase in construction output, total domestic output expands by 1.8 million rand. So there's a very large multiplier effect. This is against the backdrop of the construction sector being relatively small in South Africa, accounting only about for 3% of total gross value added in 2023. But the construction sector has very strong connections to the rest of the broader economy. Last year's mini budget noted that the construction sector has the highest employment multiplier of any sector in South Africa. For every 1 million rand spent on a construction project, it creates more than 3 jobs for individuals whose highest qualification is a matric certificate. So a wide range of sectors such as transport, communication, the trade, mining, finance and personal services and manufacturing are poised to benefit most from, if there were to be a construction stimulus. Just as a takeaway of this analysis that was shared extensively yesterday, I don't doubt the interaction or the quantum of the multipliers at all, but I do doubt if the infrastructure projects will actually materialize. We've heard this story too many times and have been disappointed time and again in the past. In order to conclude, if we look at the higher tax burden and the Laffer curve, it is very, very apparent what has transpired in personal income tax rates versus revenue collected compared to company tax rates versus revenue collected. The Laffer curve theory sort of represents the relationship between tax rates and tax revenue. And then it suggests that there's a point where increasing tax rates beyond a certain level may lead to a decrease in actual tax revenue. And it's simply based on the idea that high tax rates can discourage economic activity in the end. If we look at South Africa's experience, I think it's a mixed bag, that what we've seen between personal income company tax rates in South Africa compared to company tax rates, compared to the equivalent for at the company income tax rate level. Then lastly, I think what became clear over the last month is that South Africa needs a far richer debate on fiscal policy if it is to come up with a credible income statement and balance sheet. The last time the VAT rate was raised was in February of 2018 in that budget to fund the huge expansion of student aid. Remember the fees must fall protests back then. To go back to the medium-term budget policy statement of 2017, and there was a very detailed costing of the extra spending that was required, along with a warning that such structural increase in expenditure to accommodate new policy initiatives would have to be matched by by parallel tax increases. And a possible VAT increase was mentioned back then, and there were extensive discussions about this in the run-up to the 2018 budget. And it wasn't uncontroversial at the time, but it eventually did go through. This time, however, none of that has happened. There was no indication in last year's mini budget that the minister was about to change his fiscal strategy from spending cuts to tax and spend. nor was there any indication of big tax changes to come. So tax proposals have traditionally in South Africa been kept within a rather tight circle of the minister and a few select officials ahead of the budget to prevent anyone sort of from rearranging their tax affairs ahead of time. And that has worked fine when the ANC governed alone. But it seems they have not recalibrated a budget strategy for the new government of national unity environment. And in my mind, yesterday, what we saw is the result of Treasury that has gambled. It would seem to me that they have bowed to the political pressure from all sides to increase spending. But it funded this in the most reliable, least economically damaging way, and that's the form of a hike in VAT. I think until the government of national unity has a fiscal strategy that gives expression to its policies, it can't really be called a proper coalition. A proper spending review is, which we've had, is not a quick fix, and it's certainly not sort of a Donald Trump equivalent of sending in Elon Musk with a Doge, to slash and burn expenditure left, right, and center, as Milei has done in Argentina. I think, however, it involves a significantly more thorough process of analysis of our fiscal expenditure over the last decade and a half at least. But these issues are complex and it takes time. And I think as it happens, the expertise, fortunately, is already in government. This sits specifically within GTAC in Treasury, the government's technical advisory center, which has long conducted such expenditure reviews, but not to nearly enough effect. Maybe under the GNU can help to give it a little bit more or greater authority in this process. There's still a strong economic case to change the structure of South Africa's tax system over time, perhaps to one that relies more on indirect taxes and less on direct, especially income taxes on individuals, whose income burden, as we've seen, is already regarded as rather high by emerging market standards. Then, to conclude, there's so much to say in so little time, but let me stop here by saying that putting the public finances on a more sustainable path in South Africa requires bold action. And we should tackle spending on things that government shouldn't be wasting taxpayers' money on, just as it requires more effective tax collection and faster reforms to drive faster economic growth. It may be messy, but if the past month's budget drama helps to push South Africa in that direction, I think democracy will inevitably be the ultimate winner. Mike, I'm going to stop there because I suspect I've already gone over my time, and say thank you. I'm going to stop with that, and I'm happy to take a question if there is one at the moment. Thanks.
Thanks, Francois. As you say, a lot to unpack in such a short period of time. But if I could if you could indulge me just for one question, the fiscal dilemma that South Africa finds it in at the moment. Any thoughts on what government should be doing to try and get us out of this fiscal dilemma?
Yeah, that's the million-dollar question, Mike. The most obvious one is we need to grow out of the dilemma in which we find ourselves. We've dug this hole ourselves. The only way out of this is either to bring about significant fiscal consolidation, especially since it's not contributing to making the economy grow. It's rather wasteful, but we should unshackle the economy to allow it to grow faster. This has been researched to death. It is well captured. It is well researched. There's good empirical evidence domestically and internationally in terms of what we should do. The essence is we should unshackle business. We should make it easier to conduct business. We should change the business doing environment to remove the hurdles to growth, so that business, which in essence drives the economy, can happen or can occur much easier and at a faster pace. And if we create that environment, I think GDP growth can accelerate. And if we have an environment where GDP growth grows much faster than the fiscal expenditure side of things, I think we've got a fighting chance. But we have to focus on growth. Growth hides a lot of sins, but we haven't been growing. So we've been the opposite of that. The inverse of that also achieves the inverse. It makes it incredibly difficult to navigate and to make plans and sort of to manage the economy. And that's where we find ourselves at the moment. So we need to grow faster, and we need to create the environment to allow that to happen, Mike. And it's short and sweet.
Perfect. Thanks, Francois. As always, appreciate your contribution. Thank you.
Pleasure.
Okay, we're going to go over to the tax proposals now, as contained in Budget 2025. And maybe just as an introduction, if we start off with where the tax is going to come from, where the government suspects the tax is going to come from. We move to the next slide, please. The 2 billion, or roughly 2 billion, that government expects to collect in the next fiscal year is going to be principally derived from, as usual, personal income taxes, which comprises roughly 40% of the total tax take. Close to 500 billion of it will be indirect tax in the form of VAT. And then the other large portion of it is 331 billion rand in corporate income taxes. So corporate income tax rate hasn't increased above the 27%. VAT, we know there's a rate increase, and personal income tax we'll talk about a little bit as to what government's strategy over that was. The balancing figure of the, as I say, roughly 2 billion being made up of all the other indirect and direct taxes. So pretty much unchanged with the trend in previous years, still roughly 40% personal income tax, heavy burden on the man in the street and the taxpayer in the street. Moving on to the next slide, the purpose of the budget 2025 was designed to increase revenue collection. And I'll talk a little bit about that in the interview that was had with the commissioner a little bit later. And in addition, the purpose of the budget document, with other normal tax aspects, etc., was to provide guidance on the future of the carbon tax. As Francois raised, the tax policy proposals were designed to raise 28 billion. In the previous, let's call it version 1 of the budget, was to raise roughly 58 billion. And this 28 billion comprises principally two things. And one is the increase in VAT rate, which would bring in roughly 13.5 billion. And then the balance of that relates to the non-adjustment of the tax rates for personal tax and credits, medical credits and rebates. So no inflationary adjustment there. So I think people would refer to that as bracket creep or fiscal drag. It's roughly 19 billion rand, 19.5 billion rand. So that's where government plans to make the 28 billion. Moving to the next slide, and dealing specifically with the big ticket items. So from 1 May 2025, the VAT rate will increase from 15% to 15.5%. And then from 1 April 2026, it will increase from 15.5% to 16%. So over the period, there'd be a percentage increase in the VAT rate. Personal income tax brackets, as I mentioned, no increase for inflationary purposes, raises roughly 19.5 billion rand of additional revenue in this fiscal year. And the measures given in the budget brief were to enable additional funding in several key areas, including extending early childhood development coverage, hiring more teachers, doctors, and other clinical frontline personnel, and rebuilding the commuter rail system. And also to provide relief for poor households, government proposes additional VAT zero rating of certain foodstuffs, etc. And they also propose no changes in the fuel levy. So if you look at the budget analysis, they lose roughly 4 billion rand on the no increases to the fuel levy, which then make up for with the personal income tax and the VAT adjustment. And then excise on alcohol and tobacco products will be adjusted at higher than inflation rates for obvious reasons. Moving to the next slide. So gross revenue for 2024-2025 is estimated 1.85 trillion, which is 16.7 billion below the 2024 budgeted projection. To address the spending needs, the tax policy measures proposed in 2025 budget, as mentioned, will raise 28 billion in 2025-2026, and then the consequential take in the years to follow in 26 and 27 from the 2025 adjustments will be another 14.5 billion, which is due to the 0.5% uplift in the VAT rate, and then also not moving the brackets forward for inflation on personal income tax. So over the next 3 years, the budgeted tax revenue is expected to increase from 2.01 trillion to 2.31 trillion in 27-28, with an average tax to GDP ratio of 25.3% over the same period. Moving on to the next slide. If we look at an analysis year on year, revenue collection has fallen short of expectations due to the economic outcomes in South Africa, which is obviously distressing. The tax to GDP ratio is expected to increase marginally from 24.5% in 2023-24 to 24.7% in 2024-25. Corporate tax receipts benefited from better than expected profitability in the corporate environment. I know certain industries were up and certain industries were down, but there was a slight increase in the corporate tax take. Personal income tax collection grew at 12.6% over the first 11 months, etc. And a large amount of this increase was due to the withdrawals of retirement funds under the two-pot retirement reform. So government didn't expect that there would be such enthusiasm in terms of the withdrawals of these funds, and obviously there was a larger tax take on those withdrawals to access your savings component under the two-pot retirement system. Despite domestic VAT performing better than expected, slower imports led to underperformance of VAT collections, leading to significant downward revisions to net VAT collections compared to 2024. Import VAT collections fell by more than 20%, which is also indicative of market circumstances. So fuel levy receipts contracted by 6.5% over the first 11 months of the year, amid falling demand and large diesel refund payments. And then significant diesel refund claims will be settled by the end of 2024-2025, further reducing fuel levy collections. So that's quite interesting to see, given that many of those refund claims are the subject of litigation at the moment. Tax receipts contracted by 2.3% in the first 10 months of 24-25, compared with same period in the previous year. Moving to the next slide, please. In terms of tax policy, government also noted that there are two large long-term policies that came into effect in 2024. The one is the global minimum tax, and that is the Pillar 2 aspect, so where corporates are required to pay a minimum tax of 15% in every jurisdiction that they operate in if they meet certain turnover thresholds. And then obviously the two-pot retirement reform. Okay. I've already discussed those aspects. Then tax administration update. It was interesting to see that 3.5 billion rand would be allocated to the South African Revenue Service over the next 3 years to assist them in collection of taxes. And interestingly enough, the commissioner indicated yesterday in an interview that the funds would be applied to the development of artificial intelligence to assist with collections, to collecting at roughly 800 billion of tax debt that's due to the government, to broadening the tax base, which is always good, if you're bringing new taxpayers into the system. And quite interestingly, and I guess importantly, because it gives you an indication of where the guys are looking to collect the funds, is trying to build up capacity in the SARS itself in terms of specialized areas. And he specifically mentioned transfer pricing. So I think transfer pricing going forward will probably be the source of litigation and dispute and contention with SARS going forward, because that's where the big money is likely to be, arguably. And it's interesting to see that they will use AI and other technologies to assist them in doing that. Okay, next slide, please. So we're going to discuss the tax proposals now. And before I hand over to Roné, who's going to deal with the business tax proposals, maybe just an indication of where we are in the process. So every year in November, government and National Treasury will ask for proposals, what they call Annexure C submissions, and all South Africans, especially tax practitioners, would make use of this Annexure C process and send in proposals. Those proposals are then considered, and they then form part, to the extent accepted by government, they form part of the budget process. So most of the presentation that follows will be around the Annexure C proposals that would have been made towards the end of 2024. And where we are now is merely indications of what government proposes to do. This will then be followed in due course in July, August, when draft legislation is released for public comment and a discussion, which then ultimately culminates in a meeting in November where Treasury provides feedback on what they're likely to accept or not accept, and then final legislation thereafter, which is then released for final comment and then publication. So, Roné, I'm going to hand over to you now to deal with the business tax proposals. Thanks.
Thank you, Mike. So the business tax proposals this year, if we go to the next slide, please, relates mainly to 5 elements. Firstly, funding, interest deductions, and then also the taxation of preference share funding. As always, there is mention of proposals to change corporate tax rollover relief. We see that year on year. There are some incentives, nothing groundbreaking, and then certain changes that we'll see with regard to the taxation of collective investment schemes. If we compare this to last year, there was a lot of taxpayer favorable undertakings, especially in complex areas or where there are anomalies in legislation. Some of those were tackled in 2024. We saw that come through in the legislation. Quite a few of them, unfortunately, were not addressed. They're not mentioned this year. In fact, there's none of these apart from the one incentive with regard to infrastructure, which follows on to what Francois said about focus on the construction industry. Apart from that, there's really nothing here that is taxpayer favorable. Now, whether that is because last year was a year in which we had elections, or whether it is because of the concern with regard to the gap and where the money will come from for the expenditures, we don't know. So if we move on to the next slide, please, with regard to incentives, I have to start with something positive at least. So there's mention that government intends to release a consultation paper on vehicles that will allow a flow-through tax regime to promote investment by institutional investors in big infrastructure projects. So an institutional investor, for example, a pension fund, doesn't pay tax. And if it invests in a flow-through tax vehicle, it means that the infrastructure industry, the infrastructure projects will benefit from the investments, but there'll also be more funds flowing through for the pensioners. So the pensioners will benefit. So watch this space. Then on urban development zone tax incentives, it's been around for about 10 years. The sunset clause was March 2025, but it will be extended until 31 March 2030. And this is to promote inner city development. The last few years, we've seen a drive to promote renewable energy generating assets. That's over. So the favorable 125% allowance that was in place for 2 years came to an end in February 2025. It's not going to be renewed. The favorable 100% allowance for photovoltaic solar generating assets are unfortunately limited to 1 megawatt. Last year, government said they'll look at increasing that threshold. They've now specifically stated that it will not be considered. The standard 50-30-20 allowance for renewable energy generating assets will remain. Where these assets are leased, there are a number of limitations. Last year, government promised to look at lifting some of these restrictions, but that will not be the case. Moving on then, with regard to funding, I mentioned that there's interest deductions where we'll see changes and then changes to the preference share funding. So if we look at the interest, once it's established that interest is deductible because it produces income and the taxpayer is trading and there's income generated from the trade, then we have two sets of rules that could apply to limit the deduction of that interest. The one set is in section 23N to the left of this table and section 23N to the right of the table. Section 23N applies, so to the right of the table firstly. That section applies to particular types of transactions typically undertaken, for example, by private equity. So transactions where tax rollover relief are used or where shares are acquired, but the interest can become deductible. And that would then typically applies where the interest remains within our South African economy, but there are commercial reasons why they need to limit the interest. And the interest is limited to a formula-determined percentage of adjusted taxable income, adjusted to reflect EBITDA. And currently, that's about 47%. Now, comparing that to the left side, section 23M, that section applies where the creditor is not subject to tax in South Africa. So typically a foreigner, and that creditor is in a controlling relationship with the debtor. So it would be a foreign parent or a foreign group company. And then the interest deduction is limited to 30% of adjusted taxable income. And this is a very different scenario because this is to protect the South African tax base from money leaving the country as a tax deduction. In 2024, legislation was promulgated, so it's already enacted, but it hasn't come into effect to align these two sections. And part of the alignment is for both of these rules to apply to 30% of adjusted taxable income. And because of great concern and lobbying, these amendments will not come in until 1 January 2027 to allow more time for discussion and for government to review it. And hopefully what has been lobbied will be heard and we'll see some reprieve for section 23N on the right-hand side. Moving on, there are also a few other amendments relating to the interest limitation, which I'll quickly glance over. The definition of interest is wide, quite complex. It wasn't clear how to apply it. There will be clarification in this regard. The interest definition includes foreign exchange differences, and it wasn't clear how to deal with foreign exchange differences in the application of the rules. This will also be addressed. And then finally, there will be an additional carve-out where there are back-to-back lending arrangements, and the ultimate funding comes from a lending institution, a foreign lending institution, for example, that's not part of the controlling relationship, so where the foreign parent borrowed from a bank. If we then move on to preference shares, there are two sections that deal with the taxation of preference share funding. It's section 8E that deals with hybrid equity instruments and section 80A dealing with third-party backed shares. In both these instances, it seems that SARS have identified transactions that they feel do not align with the purpose of the sections. If we first look at section 80A and third-party backed shares, The rules apply to where there's a right of the preference shareholder to enforce performance by another person, someone other than the company that issued the preference share. And there is transactions where this application is circumvented. Now, last year already, there was changes to Section 88 to state that it will apply not only where the enforcement right is in the hands of the holder, but also where the enforcement right is in the hands of a connected person of the holder. So this seems to be a trend to expand the application of the rules. With regard to Section 8E of instruments, one of these is a preference share, which is a defined term, where the preference share, where it's linked to a interest-bearing arrangement or a bank account that serves as security or that cannot be disposed of while the preference share is an issue. And it, unless the preference share has been issued for a so-called qualifying purpose, which is a discussion that we don't have time for today. It seems that there are preference share terms structured such that it does not fall into the definition of preference share and therefore then circumvent the application, and that will be addressed. So for both these sets of rules, broader application, and we'll only see the detail when the draft bills come through. Moving on to the following slide on collective investment schemes. There was a discussion paper published in 2024 with several proposals on how to tax these investment vehicles. There was consultation as early as January 2025. There was a workshop, and in the budget, government explained that this will be an ongoing discussion to conclude on how to deal with the tax of these investment vehicles. However, there were two aspects specifically highlighted in the budget that will be addressed in draft legislation this year. The one is the use of tax rollover relief, in particular asset for share transactions and amalgamation transactions, to transfer assets into the collective investment scheme. So using tax rollover relief, it means the investor doesn't pay tax when the assets move into the collective investment scheme. And then when the collective investment scheme disposes of the assets, because it is exempt from capital gains tax, the disposal isn't taxed. And to address this, the use of the tax rollover relief to get assets into the collective investment scheme will be dealt with. So it seems like they're not now going to fiddle with the capital gains tax exemption of the collective investment scheme, but relook at how the assets come into the collective investment scheme. Another area is capital distributions. So where a shareholder owns a share, the company can make distributions either by way of a dividend, which is subject to dividends tax, or a return of capital. Now, a return of capital has tax consequences, as it reduces the tax cost that the shareholder has for the share every time it receives a return of capital. And once it reduces the tax cost to zero, it can also cause capital gain. So it has CGT consequences for the shareholder, but we don't have similar rules for an investor in a collective investment scheme. I find this interesting because most collective investment schemes, the regulated ones, cannot simply distribute capital. That's prohibited in terms of the trust deeds, but clearly this is a gap that government wants to cover. Then going on to the next, capital reorganization rules. We only have one proposed change. It deals with asset for share transactions in terms of Section 42. The general rule is that where a seller disposes of an asset to a company in exchange for the issue of shares in that company, the company acquires the asset at the same tax cost that the seller held it at. But where we, in a listed context, there could be tracing issues, and the acquiring company cannot always reasonably be expected to know the tax cost of the listed share, the asset that it acquires from all the shareholders. So there is a proviso to Section 42 that allows for a market-related recognition of tax cost in these instances. Government intends to clarify that this will only apply where the seller of the listed shares own less than 20% of the listed shares. So it will not be available where big shareholdings are transferred on this basis. Moving on. Okay. There's some changes to watch out for insurers and banks and brokers. In the interest of time, I think we can move along. Thanks, Jeffrey. From a tax administration fund, if you move to the next, please. There will be clarification on the Section 18A audit certificates that are required to be obtained by the public benefit organizations to reflect in what instances they received donations for 18A activities and in what instances they received funds for non-18A activities. Going on to the next. There will be some changes to the trustees' roles for an insolvent estate, and then quite an important one on what is a bona fide inadvertent error in respect of understatement penalties. There has been a number of cases of late where the courts had to consider what is a bona fide inadvertent error, and when a taxpayer have received a tax opinion from an independent tax advisor, doesn't that show that he's done everything he should have and that the wrong tax treatment is a bona fide inadvertent error? It seems like SARS or Treasury intends to change the legislation to only align bona fide inadvertent error with where there's an understatement penalty outside of any of the behavioral frameworks about reasonability or having conducted the affairs reasonably. This is worrying because some of these cases in fact show that the judges in the Supreme Court of Appeal and the judges in the Constitutional Court didn't even see eye to eye on what the right tax treatment is and didn't agree with the opinion obtained from the tax practitioner. So in a context like that, how can you, where a taxpayer really just want to do the right thing, how can you say that it's not enough to get a tax opinion and to rely on it? So watch that space. And that's all from me.
Thank you, Roné. I think, that's quite complete, many complex areas, and the devil will be in the detail. Unfortunately, that's always true. Robyn Berger to discuss the international tax proposals. Thanks, Robyn.
Thank you, Mike, and good morning to all the listeners. The international tax proposals were quite interesting this year. Some of the usual statements that we see in the budget annually, and then some new interesting concepts that were suggested around, tax amendments that are needed in the Act. In terms of the usual comments, we know that there's a keen emphasis and a keen focus on the implementation of the Pillar 2 reforms, which is the global minimum tax requirements. And there we see the first year was 2024 when that applied. And so people should be by now progressing their arrangements around there, with the first cash expected in June of next year. The other thing that they've discussed is the idea they'll be supporting effective revenue collection, and that comes predominantly in the cross-border space through access to information, through the exchange of information that's taking place between tax authorities across the globe. There's also the idea of addressing inequalities in the taxation of high net worth individuals. And certainly here, the focus seems to be on trust structures and how trust structures undermine or are perceived to undermine the tax system. And we've certainly seen some interesting court cases in the last few months around this. And certainly there's some specific provisions that are coming along in the Income Tax Act. They also would like to improve tax certainty. This is obviously a bland not bland, sorry, I should say uncertain or vague statement. And I look forward to seeing what is meant by this. Every day we grapple with certain provisions on the cross-border aspects, for example, the CFC legislation, that there's lots of stuff that would welcome some clarity there. The other thing they've suggested is that they would look to expand the treaty network, the South African Double Tax Agreement network, and to renegotiate some of those treaties, with the aim being to strengthen economic and trade relationships and prevent double taxation and tax abuse and enhance regional cooperation. What we do anticipate to see in this regard is certainly the ability to withhold more taxes on cross-border revenue, or to apply more tax on cross-border revenue. There's two main themes that I expect to see addressed here. The one being the disposal of shares that we regard as immovable property rich, and the other one being the ability to impose withholding tax on interest charges on a cross-border basis. Most of our treaty partners currently prevent that. In the case of interest withholding tax, for example, the US, the UK, all reduce those to zero. Moving on to the next slide and addressing some of the specific issues that we've seen around what is required in the Act in terms of amendments. There's a suggestion that the definition of equity shares doesn't cater adequately to cross-border arrangements and cross-border or foreign companies. This is fascinating because I've been doing this for 25 odd years and never really found this to be too cumbersome. So it will be interesting to see what they have in mind, and hopefully it's just clarity. The other thing that they're going to be looking at is an interaction between Section 9D and 9H, where there's the concept that certain transactions give rise to an exit without triggering the deemed exit charge. This seems to be so specific to something that is happening in the market, and seems to be a very specific structure that they're looking to address. So we look forward to seeing what the legislation looks like to understand the impact this may have. The other thing is that the CFC rules and the controlled foreign company rules, which address the high tax exemption, do not cater to the idea that some countries, for example, in my experience, I've encountered this mostly with Malta, where they actually give you a refund in the hands of the shareholder of the company for certain taxes paid, and that clawback mechanism is not taken into account on the high tax exemption. Then moving on to the next slide, we also see that, as I mentioned earlier, there's a keen focus on high net worth individuals. And when they look at high net worth individuals, they believe they also need to look at the trusts. And again, we've seen some very interesting court cases coming out where there's, the flow through of trusts is not necessarily working the way we had certainly understood it to in the past, where the courts have found that to be the case. And the next thing that they're saying is that there's some kind of interaction between Section 7 and Section 25B, which they're not quite comfortable with, and that they need to address that. We anticipate to see that this will be in the realms of saying South African trusts with foreign beneficiaries, but again, we'll have to wait and see what the legislation giving effect to those amendments looks like. And then we have quite complex rules that deal with the tax treatment of exchange gains and losses. And in the context of group companies, we have rules that effectively defer those gains and the tax treatment of those gains and losses until they are realized. Certainly that was the intention, but it's based on how we account for those exchange gains and losses as opposed to when they're actually those exchange items are realized. And so it seems that there will be a move to align that legislation more with what was the intention in terms of only triggering the tax when there's an actual realization, as opposed to simply on the accounting treatment. So not too much to discuss in the international space, but look forward to seeing what this all materializes into, because, you know, very often it has some far-reaching effects. Thanks. Moving on to the next slide. So, oh, Mike, you want to say something?
Yeah, thanks, Robyn. Appreciate the feedback on the international changes. No questions, so you're off the hook on that one. Yasmeen, we'll just introduce Yasmeen Suliman, who's going to talk around the other changes. Or are you doing exchange controls, Robyn?
I think I'm going to quickly move through the exchange controls, Mike, and then
Robyn.
yes, and then I'm done for the day. Thanks, Mike. So just moving to the next slide, please. So it's hard to discuss exchange control and exchange control reform without bringing up the FATF list and our grey listing in that regard, because certainly as advisors, what we have seen in the market is a massive uptick in investigations into parties who are non-compliant from an exchange control perspective. We have seen the blocking of funds by the Reserve Bank to a degree that we've never seen in the past. And it's really been a very interesting time. So the report is saying that at this stage, there's just two primary issues that remain that need to be addressed in the context of exchange controls. And ironically, what do they relate to? They relate to persecution or prosecution of complex money laundering and terror financing. And certainly my perception is that what we're seeing in the exchange control environment and the uptick in engagements with parties that are non-compliant, the uptick in decisions by SARB to refer matters to the enforcement unit and certainly to apply their blocking of funds is related to the FATF list. And I suppose this is a question that's yet to be answered, but you know, given that we have had this position for 5 years, where there was a statement in 2020 already that we would move to a system of everything being permitted except for a few, you know, items that are requiring approvals, and we're 5 years down the line, we still haven't seen material changes in this regard. And there are many countries that manage to police things like, you know, money laundering and terror financing, all the rest of it, but yet still don't institute exchange controls. So I am hopeful that as a country we will find a way to achieve that. But at this point, the two seemingly seem to be very closely tied and interknitted. If we could please move to the next slide. I think I made up a word there. Sorry, everyone. Right. So moving on to the capital flows management system as it's now called. Oh, sorry, we're going to address the crypto policies first. This is a keen interest for many people, I'm sure, on the call, where, you know, we had a paper out in 2021, if I'm not mistaken, where they looked at how the government will address crypto assets and how they will deal with it. I think one of the things that is particularly concerning for them is how they deal with the cross-border elements around it. They have had a struggle in terms of understanding how to classify when a crypto asset is exported from the country and when it remains in the country. Does the use of a foreign wallet impact this? Does the use of a local wallet impact this? What happens if you do not store your crypto on an exchange? What happens if you store your crypto, in fact, on some kind of secret arrangement that sits on your phone and you head off to the UK for 2 weeks? Have you exported it? It's certainly been an issue that has plagued them for some time now, but hopefully this year we'll see some progress on that, where we believe there's a new report coming out that will address it and hopefully will address the exchange control aspects of it. Many of you will be aware that globally there's been a reform around what interest rates to use, where we had quite a bit of manipulation around things like GIBS and LIBOR in the past. And so authorities have chosen to move away from those and move to new ideas and concepts. So the Reserve Bank has been working on the move from GIBS to Zeronia, and it seems that that work is pretty much complete as far as they're concerned. And now the next phase is to find a way to phase this change in. It looks like there will be legislation introduced to help with this. If we could please move to the next slide. In terms of exchange controls, as I said earlier, 5 years from 2020 budget speech and still no material changes. We saw in the budget speech this year that they announced that the 45% allowance for institutional investors will be retained. After monitoring that for some time, they've agreed that it's an appropriate level. We've also seen that there will be certain hedging arrangements that will now be allowed at the authorized dealer level, where we have people that are involved on the commodity sector. And then people who go traveling and use a travel allowance, historically you actually had to bring that back and you had to convert it to ZAR within your 30 days. But now you can bring it back and you can actually keep it in foreign currency, but just deposit it with a local authorized dealer. And if I'm not mistaken, I think that completes my section, Mike.
Thank you, Robyn. Sorry for cutting you off earlier.
No worries. Thanks so much and have a good day, everyone.
Thank you. Yasmeen, over to you.
Thanks, Mike. So today I'm going to deal with the mixed bag of the remaining proposals. I'm going to be covering personal taxes, indirect taxes, and other proposals. Jeffrey, if you can move on to the next slide, please. So with regard to personal taxes, I'm sure all of you have seen in the media, there's, as far as personal tax rates go, there's been no change. The tax rates remain the same, the tax brackets remain the same. But because of fiscal drag, it's expected that we're going to be, that SARS will be raising an additional 18 billion rand in revenue, simply by not adjusting these rates for inflation. So, if you get someone who is, earning at the lower rate, just say 8,000 rand a month, at the moment, he's probably not paying any tax because it's about at the tax threshold. If that person gets an increase, he will start paying tax at 18% immediately on that increase. So that will have an immediate impact for lower income earners, and quite quickly as well. If we can move to the next slide. There's a few things I just want to pick up on this slide. Again, the tax thresholds remain the same. The first 95,000 odd rands of income is tax-free in the hands of a person who's younger than 65 years old. The tax rebates remain the same for this year as well. But what is very interesting for me was the statistics as to who pays the personal tax bill. And there we can see a bit of a move, a shift. Previously, the number of taxpayers, well, we think about the number of registered individual taxpayers, it's about 14 odd million out of a country of about 70 odd million people. So the number of registered taxpayers, individual taxpayers, is actually quite low. And of those 14 million, at the moment, what they expect is that 7.9 million individuals will pay tax in the 2026 year. Out of the 7.9 million people, they will pay 811 billion rands in tax, which is quite a big amount from a very small tax base. But what's quite heartening, I suppose, is that if you look at that percentage, that 7.9 million constitutes 54% of your registered taxpayers, individual taxpayers, and compared to the previous year where the percentage was 48.5%. So what this indicates is that the tax base is getting a bit broader, but I think the concern still is that, out of the population of about 70 million, we only have 14 million registered taxpayers. And I suppose it's not really a surprise because, with our high unemployment rate and the abundance of youth in our country. But it's a bit concerning that, we're not really broadening the tax base or spreading out the economic benefits even further. The other interesting statistic is around taxpayers earning more than 1.5 million rand per annum. So 1.6% of individuals only 224,000 individuals pay 32.7% of the personal taxes. And that's quite a high percentage. And if you look at that bracket of taxpayer, those are individuals that are quite mobile. And over the last few years, we've seen a distinct shift in the behavior of these taxpayers, where they're using tax mitigation strategies to try and reduce their tax burden, and some going as far as moving offshore in order to get away from the tax burden. So you're really high net worth individuals looking at going offshore, financially immigrating and so on. And part of the reason, it's not the only reason, but part of the reason is our tax rates in South Africa. Moving on to the next slide, please. Next, please. Thank you. So on the personal tax front, there's a few proposals. The first is medical scheme credits. There's no adjustment for the inflation in the current year, and that's in line with keeping the tax rates and the tax rebates the same for the current year. I suppose the good news is that the credit was not removed. That was certainly a proposal put forward in order to partly fund the NHI. This year, there doesn't seem to be much talk of the NHI. But in any event, at least the good news is we're keeping a credit. It's just that there's just no adjustment for inflation in the current year. The adjustment, the lack of an adjustment is expected to raise an additional 1.5 billion rand in revenue, and simply because of inflation. With regard to cross-border treatment of retirement funds, at the moment, there's a concern that the current tax treatment may result in double non-taxation, so no tax in two countries. And revenue authorities seem to want at least some level of tax in at least one country. So there's some proposed changes to be made to exempt to rules that currently exempt certain lump sums, pensions and annuities received by South African residents from foreign retirement funds. Now, what this could have a big impact on is those efforts to try and attract retirees to South Africa. So people that have a lot of money that can spend and like to live in a nice sunny country, unfortunately, the tax planning may be at jeopardy because of these amendments. Then with regard to ring fencing of assessed losses, so there are certain suspect trades, and currently it only applies where there's certain suspect trades which generate assessed losses, where those assessed losses may need to be ring-fenced. Now, the only time that really applies is when that taxpayer pays tax at the highest marginal tax rate of 45%. Now, the concern is that there are individuals that are below that 45% level, and I know of a number of high net worth individuals that actually don't earn a lot in their personal capacity. A lot of their assets are in trusts and in companies and so on. So, the income in their personal capacity is actually quite low. A lot of them don't actually put into the 45% bracket despite being high net worth individuals. And I've had one or two instances where we were able to argue with SARS that actually the assessed loss didn't need to be ring-fenced, primarily for that reason. It looks like they want to close that loophole, and essentially the ring-fencing of assessed losses from suspect trades will apply across the board to taxpayers that indulge in those kind of activities, and not merely those that are at the highest marginal tax rate. If we move on to the next slide. Then with regard to other proposals, this was almost the hottest topic around September. It was hysterical, the number of messages we were receiving about, from insurers and media and so on about the two-pot retirement system and whether we're going to be withdrawing some of our retirement savings and so on. So, the one thing to note about this is that, it was maybe an unintended side effect, but SARS actually collected a lot more revenue than they expected from this two-pot system. So thus far has raised 11.6 billion rand in tax, more than double the 5 billion rand estimated in last year's budget. And I think that talks to the fact that there are a lot of taxpayers or a lot of citizens that are in distress that do actually need the money now rather than later. And despite the tax that's applicable on withdrawing your savings from your retirement fund, the people are still willing to incur those costs in order to get access to their funds. What is anticipated is that withdrawals will continue with many members withdrawing funds from their savings pots on an ongoing basis. So I think there's a recognition that, you know, when I've spoken to people that have been parts of bargaining council and so on, and their view is that why should we wait for our retirement funds when, you know, when we're close to death? Why can't we enjoy it while we're living, you know? So I think that's primarily the concern with a lot of people that do contribute to retirement funds, especially where they're in financial distress. You know, the idea is that why can't we have that money to really ease our life and our burden now? But there are further changes that may be required in respect of the system. So there's a call for members to have access to the retirement pots if they are retrenched and are in financial distress. Government is going to be conducting research and engage stakeholders on this topic as part of the second phase of the two-pot reforms. Then, with regard to a deceased member, any savings component can only be paid as a savings withdrawal benefit, and that's taxed on a different basis to your death benefits. The proposal is that where nominees or dependents choose to receive a lump sum benefit, such lump sum benefit will constitute part of the retirement fund lump sum benefit for tax purposes and will be taxed on a more favorable basis. Moving on to the next slide. Then from an employment perspective, there's one, well, quite a nice change, I would say, from an employment tax perspective, employment tax incentive perspective. The ETI is a subject of much controversy. We've seen lots of schemes being put out in the market, but it's a good way to encourage youth employment in the country. And we know that it's going to be retained at least until 2028. For the time being, the idea is to expand the number of people that could qualify for the employment tax incentive. The value of the incentive will remain the same at a maximum of 1,500 Rand for the first 12 months and a maximum of 750 Rand for the second 12 months. But effective from the 1st of April 2025, the formula to calculate ETI will be adjusted for the minimum, for adjustments to the minimum wage. The adjustment is related. The adjustment basically translates to employees being able to claim 60% of wages below 2,500 Rand per month as the employment tax incentive. The maximum amount of the claim will apply to employees earning between 2,500 and 5,500 Rand per month, whereas previously that band was 2,000 to 4,000 Rand per month. And the incentive will decline as wages increase, tapering to zero at a monthly income of 7,500 Rand per month. So what this means is that for employees that meet the age requirement and the 2-year requirement in terms of the length of employment, there's a bigger pool of employees that could now qualify for the employment tax incentive. I think it's quite ironic that the employment tax incentive actually pushes employers to pay employees less. You know, so the incentive for an employer is to pay the employee less than 6,000 Rand a month, well, less than 5,500 Rand a month in order to maximize employment tax incentive. And that's a bit ironic when you want to give people a living wage. Then with regard to share schemes, what's been a bugbear with many share schemes is that often the entity that's providing the fringe benefit that should be subject to tax is not the same as the employer company. And there's a bit of a mismatch as to who exactly is responsible for deducting the PAYE and paying that over the 2 SARs. So in the current year, these provisions will be reviewed to determine whether one company can act as a nominated employer in respect of all share scheme participants for the purposes of complying with PAYE obligations. So hopefully this will make it easier from an administrative perspective to deduct the tax. Well, firstly, obtain the directive, deduct the tax, and then pay across the PAYE to SARs. And moving on to the next slide. Other proposals. One proposal relates to remuneration proxy. It's a concept that is used to calculate certain fringe benefits, and it's defined with reference to remuneration. One of the issues with the definition of remuneration proxy, and typically where we see this is when you use it, for example, to calculate the fringe benefit on residential accommodation. Right? The issue here is that certain exempt remuneration will not be included as part of the remuneration proxy. It is proposed that the definition be amended to include exempt amounts. So in other words, as part of that proxy, you can include the remuneration amount that is exempt in order to calculate the fringe benefit, and that inevitably will result in a higher fringe benefit that should be subject to tax. Then with regard to permitted deductions for salaried employees, at the moment, employees have a very limited scope in terms of the types of deductions that can be claimed, and the limitation is contained in Section 23M of the Income Tax Act, 20 small m, not big M, which is interest limitations. So in any event, the issue here is that in terms of Section 6 pot, taxes paid to a foreign government can, in certain instances, only be claimed as a deduction and may not be claimed as a foreign tax credit. Currently, Section 23M does not permit that deduction. So the proposal is for the government to then expand the ambit of the section to permit a deduction under Section 6 pot. Moving on to the next slide. So with regard to trusts, the trust tax rate remains the same at 45%, in line with the highest marginal tax rate applicable to individuals. With regard to the taxation of trusts and beneficiaries, Robyn mentioned earlier, there's this amendment to address the interaction between Section 7, which is the attribution rules, and Section 25B, which is the rules that govern the taxation of trust distributions. Now, in the previous year, amendments were made to Section 25B that where distributions were made to non-resident beneficiaries, that those distributions have to be paid, have to be taxed in the hands of the trust and not, not in the hands of the individuals. So we've already tightened the screws in the previous year. So what it looks like in the current year is that they want to then potentially link distributions to the attribution rules. And where this could be quite pertinent, it could be in the case of the distributions made by local trusts to foreign trusts, which has become quite the flavor of the day since the relaxation of the ex-con rules about 2 years ago. But we'll wait and see when the legislation comes out, whether it will apply only prospectively to new distributions or retrospectively to distributions that have been made already. Moving on to the next slide. So something that hasn't really gotten much traction in the media is a positive change for taxpayers. The transfer duty rates have been relaxed in line, well, not in line with inflation, but to account for inflation. The last time the transfer duty rates were adjusted was about, I think, 2 years ago. And since then, it's stagnated. So it's a welcome change to have these adjusted. Essentially, all the bands related to transfer duty were adjusted by 10%. So currently, any property with a value of less than 1.2 million rand, well, not currently, from the 1st of April, any property that's purchased with a value of less than 1.2 million rand would be 0% transfer duty applicable, which is quite welcome, especially for your more affordable housing. Moving on to the next slide. With regard to wealth taxes, capital gains tax, the rates remain unchanged. Your inclusion rates for individuals, trusts, and companies are the same. Estate duty remains the same. Donations tax remains the same, and securities transfer tax remains the same. Moving on to the next slide. Again, no changes to withholding taxes. Withholding tax on dividends remains at 20%. And for royalties and interest paid to non-residents, those still remain at 15%. Moving on to the next slide. Then this was the big one that caused the controversy in February, the VAT and the increase in the VAT rate. The increase in the VAT rate, remember, initially it was proposed to be a 2% increase effective from the 1st of April this year. And after a hue and cry, it seems like, they're going back to the word and back on that proposal. The proposal now is that the VAT rate increases by 0.5% on the 1st of May 2025, with an additional 0.5% increase on the 1st of April 2026. And that should, by next year, bring us to a 16% VAT rate. It's expected to raise revenue in the current year by 13.5 billion. So, I suppose that's prorated for the fact that it's for 11 months versus 12 months, because the rate would only be effective from the 1st of May versus the 1st of April in the current year. But essentially, every 1% increase in the VAT rate is expected to generate about 30 billion rand in additional revenue. The thing is, with this increase in the VAT rate, it affects all households, and it's regressive in the sense that it would impact a lower income earner more, because now tax constitutes a bigger portion of their basket compared to a richer household. But Treasury still says that 75% of that revenue is derived from households in the top 4 deciles. And I think that makes sense, because those are the ones with the biggest spending power. That doesn't mean to say that the impact will be bigger on them, because they can actually afford it. The increases in the VAT rate are seen to be less harmful than increasing corporate and personal tax rates. I think this goes back to what Francois had to say earlier on about, the Laffer curve. And I think we're seeing a definite correlation between increasing tax rates and seeing a decrease in the amount of revenue collected. And I think if this is pushed too far on the VAT side, I think we could see that happening on the VAT side as well, where taxpayers indulge in, sort of nefarious activities in order to try and manage the VAT they need to pay across to us. Coupled with the increase in the VAT rate is the expansion to the list of zero-rated foodstuffs. And this is primarily to address those kinds of items that are utilized by individuals or purchased by individuals in your lower LSM categories. The types of foodstuffs that are proposed to be zero-rated are tinned or canned vegetables, dairy liquid blends, organ meats from sheep, poultry, and other animals, and specific cuts of meat like heads, feet, bones, and tongue. So if you're running a butchery, let me tell you, your VAT is going to be a lot more complicated come the 1st of May, because the expansion of these foodstuffs mean that not all your supplies will be standard rated. You have to now start looking at whether some of them are going to be zero rated. But I find quite ironic in all this is that, there's no sort of effort to give sort of nicer things, the zero rate. And if you look at what individuals in the lower LSM categories eat, the cheapest protein at the moment is chicken. But obviously the fear is that if you zero rate chicken, that's going to be across the board. So even richer people would benefit from that. So I don't think something like that would come into play. The next slide, please. Then with regard to various practical challenges that have been faced, there's a whole host of proposals that have been made. I'm not going to talk about every single one of them. I just want to pick up a few that are interesting. The first is the one that I want to pick up on is related to silver. And this is where you have many people or many inputs into the refining process of silver, where you can't actually then trace from the person who put in the silver to the export that goes out, because many people sort of silver are sort of mixed together into bars or coins or whatever it may be, and then exported. So there is going to be some changes to the VAT Act to address difficulties in tracing the origin of the silver in the refining process. I suspect, though, when this comes into play, there'll probably be all sorts of schemes that they will have to encounter, they will have to close down thereafter, as we saw with the gold industry. The other one that I want to pick up on, there's amendments to the export VAT regulations that we can expect regarding various practical difficulties. My colleague says that the regulations actually have been drafted already and will be shortly be issued for comment. Then with regard to SARS and the dispute resolution process, at the moment, we have kind of defined a dispute resolution process from a tax administration perspective, and that deals with all the taxes aside from customs and excise. And there's now a drive to align the dispute resolution process between other taxes as well as customs and excise, which is quite welcome. Then with regard to the zero rating of testing services, the issue here is that the testing services that are provided, and it's a very specific amendment, so this must have been something lobbied for by industry players. These testing services are sometimes conducted on movable goods that are in South Africa. but these testing services are provided to non-residents. So it causes a VAT leakage. What Treasury is going to do is look at whether some of these zero rating services, testing services could be zero rated. Then, in line with what Roné said earlier about where there is a court case that seems to be unfavorable to SARS, Treasury then looks at amending the legislation. We're now looking at the Capitec case, where the taxpayer had some, I would say, some level of success. It's proposed that the definition of insurance will be updated in the VAT. So I think it's a clear reaction to the ruling in that case, similar to what Roné mentioned earlier with the bona fide inadvertent error. Then, with regard to airtime vouchers, a very specific amendment where airtime vouchers are sold in South Africa, but for exclusive use in a foreign country. The idea is for those to be, that treatment on that to be clarified, and presumably that should be zero rated because they can only be used in a foreign country. And then, essentially, all these adjustments are really there to modernize the VAT framework, improve admin policy, and then address practical compliance challenges. Moving on to the next slide. Then an amendment that's aimed at Shein and Temu and these kinds of online retailers. At the moment, there is an exemption in the VAT Act for low-value imports, where customs VAT does not have to be paid on low-value imports into the country. The government proposes to review the legislation related to the VAT treatment of these imports, particularly from online retailers who do not have a VAT presence in South Africa. And the idea is to achieve parity between these online retailers and your local retailers where there's no choice but to charge the VAT. And moving on to the next slide. Excise duties on alcohol and tobacco. As per usual, there's an increase in excise duties on wines, beers, and spirits by 6.75%. There's an increase in excise duties on cigarettes and vaping products by 4.5%, and pipe tobacco and cigars by 6.75%. Now, one can't help but think that this is just going to further drive the illicit economy. The higher these tax rates go, the more attractive it is to use to use an alternative that is cheaper, on which no excise duties were paid. So I think it's quite ironic that we're seeing these big increases still, given the damage despite the damage to these industries by the illicit trade. One amendment to note that in future, excise duties on alcohol and tobacco will only take effect on the 1st of April and not on budget day. So currently, as soon as the announcement has been made, the excise duty rate changes, but going forward, that timing will change. Moving on to the next slide. Next slide, please. Fuel levies. On the general fuel levy and road accident fund levy, there's no increase, which is quite a welcome proposal. There is an increase to the carbon tax on fuel, and this is in line with carbon tax generally being increased. On petrol and diesel, on both of those, the increase is 3 cents per litre and effective on the 2nd of April 2025. What's interesting is what is the tax as a percentage of the pump price? On 93 octane petrol, 28.1% of the pump price is attributable to tax at the moment. And it's higher on diesel at 30.2%. So it's quite a big chunk out of our, that we pay at the filling station. Moving on to the next slide. On the carbon tax, there's quite a few changes, many of them positive in favor of the taxpayer. The one that's not positive in favor of the taxpayer is the carbon tax rate. The carbon tax rate is increasing from 190 Rand to 236 Rand per ton. And this is effective for the 2025 year. We're already in the 2025 carbon tax year, which coincides with the calendar year. Then proposals arising from the stakeholder comments on the discussion paper. So last year, a discussion paper was issued by Treasury, where the outcome of engagements the outcome of various investigations into the carbon tax were laid out. and stakeholders made comments on the discussion paper, and this is now what's been proposed in the budget speech. Almost all of them are positive, which is quite heartening. And I think there's also recognition, and maybe it's in light of how the Americans are now viewing climate change, that it's not as important any longer. There seems to be an acceptance that carbon tax is going to have a big impact on industry. So there seems to be a softening of the stance, where previously it was very, very clear that by 2030, there was going to be quite a harsh regime as far as carbon taxes go. So the changes that are coming through, the first one is to extend the Section 12L, the Energy Efficiency Initiative, by 5 years to 31st of December 2030, which is quite a welcome change. So despite the fact that we're not going to, expanding on renewable energy allowances and so on, energy efficiency is still a focus. They're going to extend electricity price neutrality to the 31st of December 2030. And I think there's a recognition. I think it would be detrimental to the country if we had to add to our electricity price the cost of carbon as well. Then increase the carbon offset allowances by 5% from the 1st of January 2026. So currently, the rates, depending on whether it's fuel combustion or whether it's fugitive emissions, at 5 or 10% respectively, those rates will be increased by 5% from the 1st of January 2026. Then carbon offsets that were generated from projects that were approved prior to the carbon tax being introduced, those will be retained and can be valid until the 31st of December 2028, which is that's quite a welcome change. Then with regard to the performance allowance, trade exposure allowance, the 30% trading intensity thresholds is still going to be used. There was a proposal that it be moved to 50%, which means that there had to be higher competition from imports in order for the trade exposure allowance to become applicable. So I think there's a recognition that the 50% is too high. So South Africa still can't be as competitive. Then a good change is the maintenance of the basic tax-free allowance until the 31st of December 2030. Remember that they were gradually going to be phasing out the basic tax-free allowance while increasing the tax rate as well. And that would certainly ramp up costs for a lot of commodities that are subject to the carbon tax. Then from a carbon budget perspective, for those companies that participate in the voluntary carbon budget system, that will be retained until 31st December 2025. So there's certain allowances that are available simply for participating in the carbon budget system. It doesn't have to do anything with meeting any specific targets at present. It's just participation is sufficient, and a welcome change that this is retained until the end of this year. And then there is a change for the performance allowance related to the electricity sector. The intensity benchmark has been set at 0.94 tons per carbon CO2 equivalent per megawatt hour for that industry in order to qualify for the performance allowance. Moving on to the next slide. There's other miscellaneous taxes. The two that I want to just touch on is the health promotion levy, otherwise known as the sugar beverage levy or the sugar tax. There's no further increases proposed this year, which is quite welcome. This tax has made a big impact to the sugar industry and really has caused quite a lot of damage. I know from a health perspective, there's a reason why we do have this tax in place, but unfortunately, the side effect, especially where I'm based in KwaZulu-Natal, has been to decimate the sugar industry. So from my perspective, I'm quite glad there's no increase to sugar beverage levies for now. On smartphones, currently there's a 9% ad valorem tax on smartphones. The idea is for those ad valorem taxes to be removed on phones costing less than 2,500 Rand each. And this will be effective on the 1st of April, 2025. Next slide, please. Then on the customs front, there's been a few proposals. I'm just picking up a few that I think would have quite a wide impact. And it's related to customs modernization. There's a proposal that the voluntary disclosure program be instituted or established for customs and excise licenses. We already have a voluntary disclosure program that applies to other taxes except for customs duties. So this is quite welcome. It's nice to encourage voluntary compliance and allow for taxpayers to come forward and regularize their affairs. So this is quite a welcome change. And then with regard to the timing of adjustments to bills of entry, there's going to be a new flexibility that is going to be introduced. And it's intended to accommodate scenarios where businesses need to make corrections to the import-export documentation, but are constrained by rigid timelines and rigid requirements. So the idea is for the Commissioner to prescribe alternative timelines and mechanisms for such adjustments, including the adjustment for multiple entries by a single correction document. For example, where you have transfer pricing adjustments, where you've got multiple imports into the country, but it's a single transfer pricing adjustment at year end to fix your transfer pricing to be within the benchmark ranges. The impact of that is having to adjust each of your bills of entry. It would be quite convenient if that could be done as a single entry versus adjusting every single bill of entry for the year. And then with regard to bulk export shipments as well, where there's invoice amendments that may be necessary once the goods have left the country, it's not necessary to process an adjustment for each bill of entry, where a single entry could adjust multiple bills of entry at the same time. So this is quite a welcome change. And if I'm not mistaken, I think that brings me to the end of my segment. Jeffrey, you can just check the next slide, please. There we go. So I'm going to hand over to Mike.
Thank you, Yasmeen, for taking us through all the other tax amendments, always very interesting. I think we have one question. We've got very little time left. Maybe let's take the one question. And I think, Francois, this looks like a question you'd be able to answer, or attempt to answer. If I read the question, it says, given intercontinental trade aspirations and drive, reduced tariff means low taxes for imports from South Africa. What is the implication of this on the South African revenue, and where do you see government clawing back from this, given that high-paying jobs are fewer from the current economic activities, and current economic activities are not generating formal employment?
Yeah, thanks, Mike. In the South African example, import tariffs do not make such a large fiscal contribution to, or such a large contribution to fiscal revenue. Of course, it does bring in cash, but it brings in much less than is what is happening in other African countries, which are that have also signed up for the AfCFTA. Import tariffs are easy to collect, similar to VAT. Not that I support higher import tariffs or higher VAT at all. That's a different story for another day. But the idea with the CFTA is that increased trade across borders will in fact grow the economies, and that South Africa will benefit from larger economy and therefore larger tax revenues, not necessarily via import tariffs, if the economy grows. One thing that we need to remember is that many other African countries do not have the same tax collecting ability as what we have in South Africa with SARS. But one has to put this in context. The big driver that will unlock enhanced levels of intra-Africa trade is not a reduction in tariffs. It's actually a reduction in non-tariff barriers. And non-tariff barriers are much harder to remove or to liberalize or to do away with. So it's not as if there's a lot of talk about this continental agreement. This continental agreement is a lot of hot air. It's free trade agreements are so incredibly complex and such a large gray areas with them. These changes of us trading more with the rest of Africa as opposed to with the rest of the world is not going to happen overnight. And to put it into context, maybe to conclude, we do not have a tax revenue problem. It's not as if we are struggling, to collect taxes. We can, of course, do better, and SARS is going to put some measures in place. But if we give them the cash to do so, which would be sort of silly not to do, because they're very, very good investment to invest cash in, yeah, from a government point of view. The problem with non-tariff barriers is they are much, much harder to remove. And sorry, just to come back, we don't have a tax collection problem, but we have a tax efficiency problem when we spend cash. So we're reasonably good, at least compared to the other African countries, at collecting our taxes. Not all the taxes, but many of them. Where it goes wrong in South Africa is when we dish out what we've collected to the various departments, and the misspending then happens. So yeah, it's not going to have a big impact on South Africa, Mike.
Thank you, Francois. And I think that brings us to the end of this webinar. So thank you very much to the panelists. Thank you very much to you as the attendees, and thank you very much to the Bowmans Tech Support and Marketing teams. Have a blessed day for the rest of the day, and see you guys all soon. Thank you very much. Goodbye.